Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you for joining us. Today we're going to be looking at Anheuser-Busch InBev, the Belgian brewery company, the largest brewery in the world that has purchased a number of the top beer companies over the years. We're going to look at their 10K that was issued in 2019 and see where their stock stacks up currently relative to what they've done in the past and whether it warrants an investment today given the price is down from its recent highs. To give you a little background before we dive into the InBev financials, let's take a look at what they've done historically. So in 2008, InBev purchased Anheuser-Busch Brewery Company for $52 billion. And at the time, I recall the Anheuser-Busch shareholders resisting the acquisition and that InBev had to pay a sizable premium to the current price to get the deal done. But ultimately they did. They bought the company, consolidated, and continued on. And then fast forward to 2016. In 2016, the new combined AB InBev company just purchased SAB Miller and got the Miller assets. They paid $107 billion for that company, those assets. That was in 2016. They promptly, due to U.S. regulations, had to sell to Coors the U.S. Miller assets. So after buying SAB Miller, which came with a host of brands globally, they had to carve out the Miller piece and give it to Coors as part of a trade deal to get regulatory approval to do the deal within the U.S. They did that, they sold that for $12 billion. And they've also had to sell off a couple other brands throughout the globe for different regulatory reasons here and there. Fast forward again in 2019, they've sold off a division to Asahi Beer for $16 billion, an Australian division. They've taken a division public, a minority stake public on the Hong Kong exchange, and they've most recently bought the Cutwater Spirits distillery here in the States for an undisclosed amount. Now I'll tell you, whenever I have in my past worked on a public transaction and the purchase price is undisclosed, it's only ever undisclosed because you paid too much for the company, and you don't want to tell your current shareholders actually how much you paid for it. You also don't want to tell the marketplace for any future acquisitions what you paid for it. So I don't think that bode too well for them saying just not disclosing the price. Additionally, if you listen to that laundry list that I went through over the last decade, does that sound like a brewery company to you, or does that kind of sound like a private equity group with all the financial transactions? It does to me. It sounds a little bit like management is in a mature market and they are eagerly trying to prove their worth and show shareholder value by acquiring other brands, which is a totally legitimate strategy. The trick is not to pay too much for them. And if you recall the fervor, the resistance and fervor from the Anheuser-Busch family, well, family was in for it, but other shareholders did not. That caused a premium. You've got the Miller acquisition, which was a big premium. Then the subsequent selling of some of those assets. And now the Cutwater Spirits for the undisclosed amount, which I'm assuming was a big premium. That to me seems like a management team that's super eager to close deals, more so than really make beer and grind out a profit and produce shareholder value that way. The other thing that I thought was interesting is you go through this 10K and you're going to see the Goodwill and the intangible assets grow tremendously over the decade. So I went back in 2009 and I looked at the Goodwill for Anheuser-Busch InBev in 2009 after the Anheuser-Busch purchase, and it was roughly $75 billion. And then fast forward to today, 2019, Goodwill and intangibles have ballooned to $170 billion. So an extra $100 billion is added on to Goodwill. Now, if you subtract that from total assets, you can get the essentially tangible assets, which is only $66 billion. They have far more debt than that. And it leads me to believe that all this activity that they've been doing has been doing nothing more than adding goodwill and intangible onto the balance sheet because they've been overpaying for the acquisitions they've done. So let's take a look at the financials. We'll see what has transpired as a result of these acquisitions over the years. Have they increased or decreased shareholder value? And what we can think about management and their prudence, and what does that bode, how does that bode for the future? Okay, so this is the 10K. I highly recommend that you read it. It's extremely interesting and gives a tremendous amount of information to their balance sheet and what they've been doing. But I'm going to skip this because you're going to go through and read it. And I'm going to show you the 10 years of data that I've pulled out from this and previous 10Ks. So here we go. Here's their historical revenue and EBITDA, leverage rates, and enterprise value. And let's walk through this and see, does this meet our 5 criteria that we set out for a prudent investment? And those 5 criteria would be the top line revenue growth, earnings growth as we define it by EBITDA, free cash flow growth, strong balance sheet, and a well-priced stock. Okay, let's look at revenue. So revenue, this summary line here is 2009. So I went back further than I normally do because I wanted to see how they performed right after the acquisition of Budweiser in 2008. So this is 2009. I skipped to 2011 to give me the decade of performance all the way to 2019. And you will notice that revenue is growing. It grows here from 26 to 29, holds about 29 to 40, and then spikes up to 56. This transition, this $45 billion to $56 billion, that is the acquisition of Miller. So this $10 billion lift in revenue cost the company $100 billion. So this growth is from that outlay of cash, or debt in this case. And revenue actually fell to $52 million at the end. Or operating income, again, this is earnings from the P&L before interest, tax, and some of the other below the line, if you will, items. You can see here, right after the acquisition of Budweiser, that around the $11 to $12 billion range, it sits there. They've got a nice pop here of $20 billion, but then it reverts down to 15, 13, kind of struggling. They're probably feeling the burn that they need to get a deal done because earnings are declining. 12, and then they hit the acquisition, spikes up to 17, and then comes back down. So it's an interesting pattern of kind of plateauing after the deal. It looks like they're getting a little pressure. Management feels like they need to get something done to justify what they're doing. Let's go get a big deal done. Everyone goes, hurrah, we got a bastard deal done, synergy, blah, blah, blah. And then in the end, declining earnings or declining operating income. Amortization, I'm adding back, and depreciation. One-time adjustments. Now this is interesting. Most of these one-time adjustments are actually goodwill impairments or charges related to shutting down businesses or selling off businesses. So there's an awful lot of churn going on in their portfolio of brands. Now they have over 200, so it's a massive amount of brands. I get it. And if you look at it relative to EBITDA, it's very small, 2% or so. So I went ahead and added it back. It's nothing too egregious, but I'm a little skeptical that they've got this $170 billion goodwill and intangible asset on their balance sheet, that if the auditors look at it and say, listen, you have this here, but I look at the performance of the companies that you bought, and that performance doesn't substantiate the goodwill, they're going to have to write that goodwill down. That's going to be a massive charge here, which would impact the EBITDA. So I want to just take that for a grain of salt because I do believe that is a risk that's on their balance sheet that's not borne out in the P&L just yet. But let's keep going. Let's look at EBITDA growth. You'll notice EBITDA growth is 6%, going from $15 billion to $20 billion. That is after they paid $100 billion, $107 billion for Miller. So if you back that transaction out, the growth is not great. I would call it weak. weak revenue growth and weak EBITDA growth. Debt, take a look at debt. We've got, 2011, they had $43 billion of debt. This includes, there's a pension liability in there as well. And you can see it absolutely balloons, plus the, $75 billion to buy the Miller Company. And they've been chipping it down. They've been scraping and scrimping to try to pull that back down to earth. I'll show you what's done to the debt load and to the EBITDA calculations. So they've grown debt here. You can see market cap. Market cap, again, is just share price times outstanding shares. So I'm pulling, their fiscal year ends December 31st. So I'm pulling the average December month stock price times the shares outstanding, gives me a market cap. I take the debt here. They don't have any excess cash that I found. Add the market cap, I get the enterprise value. And the enterprise value has gone from $140 billion. It's increased to a high of $300 billion, and then back down to $26 billion of free cash. Now let's look at our metrics. So now our metrics, EV to enterprise value, that's EV to EBITDA. That is enterprise value to EBITDA. That's their trading multiple that the market has assessed. Right after the Anheuser-Busch acquisition, they're trading at 10 times EV to EBITDA. That then spikes to 12, comes back in line. I'm guessing that's, they got a little pop in EBITDA here, so that's they got a little reward there. 9 times. Then it starts going up, I think, as their EBITDA is coming down. But I think this is general, our financial markets are increasing substantially during this period of time. So I think this is a pretty healthy growth in the financial markets. And they get a lot of credit. And with this increased wealth, they go out and do the big deal in 2016 here at the 18 times, at the kind of the peak value of their stock, they close the deal. So I think that's investors saying, hurrah for this monster deal that they did. They're going to be able to consolidate the two operations and realize all kinds of synergies, and there's certainly lots of spreadsheets and fancy MBA words that they use to justify the deal. But what happens is you see as earnings decline. And as earnings decline, the street realizes their error and starts assigning a smaller and smaller multiple to the company, and the share price continues to fall. You'll also notice here the debt to EBITDA, as in order to get the deal done, they had to lever up. They went from, call this 3x EBITDA to 7.5x EBITDA. They've pulled this back. They're at 5 currently, having to chunk down a tremendous amount of cash to do that. But 5 is still above what we like to see. Remember, we're looking for 3 maximum. A healthy company has 3 turns of EBITDA and senior debt. That's what you want. 3 to 5, it's kind of high-priced debt, so junior debt, if you will. And then 5 north comes kind of more hard money or specialized mezzanine capital. It's kind of a bridge between equity and debt. Here they don't have any of that. They're all senior loans. They're just more expensive senior loans. And for us as equity holders, it's just too much. You look at their balance sheet. In fact, we can go to it. Let's just see if I can get to it. 86 is the page. Let's go to the balance sheet. Here we go. 1 second. It'll be worth it. If I can find it. If I can find it, it'll be worth it. Here you go. So here's the balance sheet. It's a little off from the standard American format. Typically we start with current assets, long-term assets, current liability, long-term liability. They do it in reverse. They have non-current assets, so long-term assets are up top of the balance sheet. And you can see right here, I'll zoom in. So Goodwill and intangible assets. $128 billion, $42 billion. I'm basically summing these up. And that's how I get the $170 billion. right? 8, 2, 10, 6, 7, yeah, that's 170 billion. Then come down to total assets. Total assets here, total assets, $263 billion. So of this, 170, that's 70%, 72% of their assets are assets that you can't sell. They're not physical assets that you, in a bankruptcy or some sort of distressed situation, could actually liquidate. That's essentially the premium they paid for Budweiser, and the premium they paid for Miller, the premium they paid for Cutwater, and I'm sure a host of other deals that just are so small they don't actually warrant disclosure, but they stack up nonetheless. And if you dig into the detail, it's global. So there's Goodwills across the globe as they have purchased companies. And so if you're looking at a company that's highly levered, you look at the assets to see, well, if something happened, could you liquidate, get your money back? Here, no. There's $66 million of net tangible assets. They have 66 billion of tangible assets. They have 100 billion of debt. You're upside down 2 to 1. All right. So I still think this 5x is risky for our perspective. All right. So this is the P&L. I will. Let's do one more thing. So I want to show you if they were to bring this in line. So let's say we're at 5x right now, EBITDA. We want to bring it to 3x. So what I'll do is I want to look at the amount of debt that they have on the books. They've got 105 billion currently. We're saying maximum is 3 times EBITDA. That means the maximum debt load is 62 billion that they could have. Minus the 2, they have to pay down $42 billion. Okay, I'll show you in a bit. Their average debt payment's $8 billion. Divide these two, that means it's 5 years that they're going to be chunking down this debt to bring their debt balance from 5 to 3 turns. That's assuming no growth, right? You can always grow your way out of debt, but given the fact that they're a very, very mature industry, a business, and that earnings have been declining, I'm not going to give them credit to grow their way out of a problem. I'm going to say it's going to take 5 years, and it's essentially going to suck up any free cash flow they have. It's also important to note that if you look at the detail of their dividend policy, right? So we talk free cash flow all the time, which is essentially includes the dividend that they could distribute. But what you'll see is they actually pay out a dividend every 6 months. But that total dollar amount that they give each year has been declining 3 years in a row. And that's declining because they're trying to chip away at this debt that's so big and earnings are declining. They simply can't afford to pay the dividend they once did. So while the share price is currently down, and I'm sure you're looking at it it must go back up, right? And then you're saying, well, there's a high dividend yield, so if the share price is down, I'm getting a high dividend yield, I can wait for the stock to come back. Yeah, but they might cut the dividend again. Okay, they've cut the dividend 3 years in a row. They're staring at more debt. They're staring at 5-year payback period. So be careful assuming the dividend's constant because it's cut. It was cut from $7.8 billion. It was paid out in total in 2018 to $5 billion. So they cut it by 2.7, almost $3 billion. That's a big cut. Let's be careful. Let's go up to the cash flow now. My personal favorite statement: the cash money where the rubber meets the road. All right, cash money 2011 through 2019, and as a benchmark for the post Budweiser acquisition, I went to 2009 just to give you a little further perspective is probably the right word. A better perspective on what they did post big acquisition last time. All right, so here we go. $9.1 billion up to $12 billion. Excellent. That means they bought the company, they bought Budweiser, and they were able to realize some of the value that they thought out of the business in terms of cash. And that cash grew 9, 12, 13, 13, 14. Decent. Okay? Also, you want to see the spread here between what they realize in cash and what they have to put back in their breweries. And that is actually, it doesn't take them much cash to put into a brewery, which is great to see. This here nets them about $10 billion a year in free cash flow. That's cash flow from operations, running and making the beer, selling it to customers, collecting the cash, and then reinvesting in the mill. So new copper stills, new stairways, lighting, whatnot, to keep the trucks, infrastructure, to keep the thing running. After all that's said and done, they have $10 billion left in cash in the bank, which is excellent. But what I'm seeing here is a decrease. So 12, 13, 14, 15, 14, 13. Wait, what? It peaks at 15 right after the acquisition. Excuse me, that's 17. It peaks in 2017 at $15 billion, and then declines 14, 13. Meanwhile, Capex is going up. That's right. So the margin here is shrinking as they try to consolidate and integrate with Miller, ASB Miller, and Cutwater, and all the other companies that they're buying. They're spending more and more. Meanwhile, they have big debt payments, right? So they had a small debt payment in the past, well, some, but it's really grown. In 17, they paid $11 billion in debt. They had a side. This is actually them borrowing to buy the company. So you kind of have to write that year off. You can't actually distribute the $64 billion, right? That went to the Miller Group. But I just want to leave it in there to show it. Post-deal, right, where I'm getting the $8 billion of average payment, that's essentially averaging this. They're chunking down their debt at $8 billion a year. I took the excess they need to buy down, divided by 8, I got the 5 years. So what does this do? That means $10 billion here of free cash flow minus the 11 means they lose $1 billion. Or here they gain a little bit, but they're basically break even here. So the cash, if I look at shares and I look at free cash flow per share, look at this. 4.44, which is fine. That's after the Budweiser acquisition. Drops 2.28. Okay, but it bounces right back. 8.5, solid. 8.9, solid. 8, solid. 5.7, okay. This 37, dismissed because they borrowed the debt. It's thrown off the number. Fine. Negative 47 cents. $2.2, 11 cents. So after the deal, after the purchase of I blanked on the name. SAB Miller. After the purchase, earnings are down, free cash flow to equity holders are down, debt is way up. All right. Now we'll look at the yield. What's interesting to note here is, yes, it averages 8%, which is a strong yield. It's one of the highest we've seen thus far, but this calculation is thrown off by this 36 here. So really what you want to do is you want to look at kind of the yield before the acquisition of Miller. That average is 7%. And then after, that average is 1%. So they went from yielding 7% to yielding 1%. That's not good. The growth rate is 2.6% as an average, but again, I think this here throws that growth rate off. That growth rate is actually negative. If you look at just these numbers and these numbers, that's a decline over the decade. So this decline makes it very difficult for us to forecast forward, right? So what's the point of this? The point of it is to take our existing cash flow, which should be stable and going north, existing EBITDA revenue, which should be stable and going north, and take those forward. The problem here is they're kind of declining, and they're so close to zero, it's very difficult to tell what's going to happen. Are they going to be able to realize synergies from Miller? It doesn't really look like it. They've had several years post-acquisition. They bought it in 16. This is through 19. It's going the wrong direction. Do you assume a turnaround? I don't know. You're kind of betting on them going out and buying Cutwater or some other company and being able to grow that business, which is in and of itself a whole new risk. All right. So what do we do from here? I think let's go forth and forecast what we think the economic return would be with a couple assumptions and see where it comes from it. We'll start with the cash flow. All right, so I'm going to pick up cash flow and I'm going to go forward in time. And remember I said that the $8 billion of debt payment that they're going to have to make, cutting the dividend, possibly cutting the dividend, I think that's basically going to almost zero out or make cash flow to the owners very, very weak for the next 5 years as they pay down that debt and bring it back in line. Once they do that, they'll free up cash, and so then it's going to go from 0 to kind of 4 really, really quickly. In 4, I'm taking the average kind of free cash flow with less debt on it. And then I'm going to grow that at 3% because they're a low-growth company. I then use the $8 of earnings, free cash flow, at an average yield that they produced historically to get $118 as a future value price target for AB InBev. Let's now go look at EBITDA and the EBITDA forecast. So basically here I'm just going to pick up EBITDA from where, oh, you're not there yet. Let's give it a. So here's our EBITDA forecast. As you can see, I'm picking up a $21 billion of EBITDA. That's basically taking the 2020 EBITDA and growing it at 3% a year, something similar to what they've experienced in the past, and coming down to a $28 billion value in the future. I'm also giving that a 15 times multiple, which is probably a pretty strong multiple. If you wanted to use the average here, what they've had in the past, which is probably more reasonable, that's a 13 times. So let's lower that to 13 times. Our debt is 3 times because we said we right-sized the debt over the long term. Outstanding shares, share price of $139 a share. So now let's go look and see where they're trading currently. They're currently trading at $49 a share, and that is a steep discount to where they have been historically. We're forecasting 118 and 139. We'll average the two for $128 in the share price. Let's go look at the IRR calc. So here, IRR calculation, I'm taking basically, again, the 0 free cash flow to equity because I don't know what's going to go in the near term. They got too much debt. They got to buy it down. They've cut the dividend. They'll probably cut the dividend again. I don't know if we're going to get a payment, so I'm going to just zero it out to be safe. That'd be like your margin of safety. All right. I buy the shares today, $48.90. 5 years, 5 years from now, I pick up my cash flow and I exit at our average future price of $182. And what does that mean? That means a 15% IRR. So I think what you're seeing here, I think you're seeing a market return. 15% over a decade is about what the S&P 500 does. I think that's saying that the $49 current price is an appropriate market price for the stock. I know, it bugs me too. You look at the stock price, we'll go over and look at the stock price. It has fallen from $125 to, I said, $49. I'll put the 49 bucks right here. Right? That's a monster decline. What happened? Well, A, they made a massive acquisition, right? They talked all about synergy, shareholder money raining from the sky, and it really hasn't panned out. The EBITDA that they were forecasting, the EBITDA that has come through, has been a lot less than the growth they were showing before. So I think what's going on here is the company was trading at a 9-10 range of market multiple prior to the acquisition. Okay, the acquisition, the market roared higher. They did a deal at the peak. Everyone was like, "Yay! They did a monster deal, the biggest deal ever." You know, they're gonna reap all kinds of free cash flow. And then people are realizing perhaps that's not the case, or there's more risk, or it's harder to do, or what have you. and the market valuation's falling back in line with what it has been historically, which is 9-10 times. So now if I look today's value, right? So this would be today's value using the $49 share price with the debt, market cap $97 billion, enterprise value $200 billion. They've essentially erased all the value that was created by the market run-up when they bought Miller. So they have enterprise value of $300 billion at the peak, back down to $200 billion. They paid $100 billion, so the market's erasing that transaction. And I don't think that even though it's cheap, even though the stock price is down, the IRR is not reflecting an abnormally high IRR. You would think if the market, if it was mispriced, right, and the stock price was truly below market value, then that IRR going forward would be north of 20%. It'd be north of the market for sure. But at 15%, that's a market rate return. So I got to think that I have to think it's fairly well priced. So believe me, my gut is like, oh, it's down. It must be of value, and I tear through it. I'm like, I just don't see it. I just don't see it going north. I think the increased price you had was the market just being euphoric about a deal, and not necessarily saying these guys are going to print cash into eternity. Therefore, they need a higher price. So let's recap here. Let's recap what we have. We've got a company with weak revenue growth and weak earnings growth. You might even say recently it's declining. So you might call it net zero or net low, but generally lower than we would like to see for top line and EBITDA growth. Free cash flow is declining. Certainly recently it is down. Balance sheet is levered with few tangible assets that we could actually sell if we need to. And I'll add another one. We've got a management team who seems to really love doing a deal, and I get it. Doing the road show to close a monster transaction has got to be just euphoric. I mean, I can picture it. Jump in the private jet, jet off to Los Angeles, San Francisco, Chicago, New York, Boston, meet with all the big players, rake in checks of billions of dollars, and go to a big dinner and spend tons of money. That's a wild ride. I mean, I've been on it. Been on the private jets, did the fancy dinners, raised a ton of jack. It is a lot of fun, and I think these guys, A, need to close a deal to show that they're doing something, and B, get pitched by investment bankers constantly about deals. And while they should be turning them down and preserving their cash, they're saying yes and spending it. The other thing I want to say is, had they not done this deal, had they not bought Miller and waited another 4 years, okay, from 16 to 2020, where we are now, the giant decline that we're having in the equity markets as a result of the coronavirus, Anheuser-Busch InBev would have been in a much different position with more cash, a solid balance sheet, stable growth, right, small but not declining, and all their competition would have been cratered, right? So I looked at Diageo as an example, and Diageo's at least market cap right now is less than $100 billion. AB InBev, had they not tied themselves to Miller, could have done a beautiful diversification play and picked up a beautiful company like Diageo, and went from a monster player in all beer to really a split player between liquor sales, which is trending higher, and beer. That would have been a really neat play, but instead I think they got eager, did a deal, and now they're working their way through. It's going to take years. All right, so we said that there's some issues, and it doesn't meet our revenue growth, EBITDA growth, solid balance sheet, free cash flow, and well priced. The price is low, but because of management's overzealousness, I think we're going to pass. I'd like to see more discipline on management, really buying companies at their fair value and not just piling goodwill on the balance sheet. But if the share price continues to slide, let's say they cut the dividend again, or they cut it to zero, right? If they did that, the share price is going to go down. If they did it, how far down does the share price need to go to make this attractive. Because ultimately the fundamental business is very interesting. A global provider of beer, beer's not necessarily going to go to zero. Certainly it's a great hedge against a recession. Alcohol tends to perform well. So let's look at a price and figure out what does it need to have for it to really work for us. And what I've done here is a quick sensitivity table. So in order for us to get a close to a 20% return, we need a price target of $35. I'll take that even lower. I'll say $30 gives me a 21% annualized IRR over a decade. Now that is truly an outstanding performance if you could get this. Put it on your watch list. There's got a lot to like here, and I really wanted to say to buy it, but I'm going to have to give it a meh. Because there's a lot to like here. Revenue is low and weak, but it's there. EBITDA is weak. I could see it turning around in the future, long term. Certainly their brand positioning is second to none. I like alcohol because people tend to consume alcohol all the time. There's a lot to love here. I'd like the management company to be more prudent, and so as a result of that, I want to see the share price come down more to give me bigger a margin of error, a bigger safety cushion, and for that I need it to be about $30, $35, and then then in my opinion would be a good deal. It's worth the risk at that point. But for now, we're going to call it a meh, and we're going to pass. Thank you very much for watching. I really appreciate all the comments, the reviews. Please subscribe to the channel. My name is Cameron Stewart, CFA. Thank you so much for watching Rational Investing. Bye-bye. I think if you're watching my video on AB InBev, I really appreciate you watching the video. You may have heard my daughter crying in the background, and I want to make sure that you're aware that no babies were harmed in the filming of this video. She's approaching 2 years old. It's roughly midnight here, and tonight she's just awake. So thank you very much for watching the video again. See you next time. Bye-bye.